Well, good evening, everybody, and welcome to the November 2021 Roundtable. We're going to have some fun tonight, I think. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing, and I'm joined here by a number of dear colleagues and ravenous investors. Starting with Kim Butcher on the left there. Kim joins us from Florida, and she's been a guest damsel a number of times. She's a regular here, and she's been a investment education. We'll call her a raconteur also. Welcome, Kim.
Wow, a racketeer. Okay, a new name. I didn't realize.
Not a racketeer. A raconteur.
Raconteur. Well, if I'm going to be a raconteur, I think I should have a glass of whiskey next to me.
Well, that would work, but we try to behave here a little bit. Oh well. Second in line there from the left is Mr. Kavula. Good evening, Ken.
Good evening, Mark, and I'd like to welcome you on behalf of the Mid-Michigan chapter of Better Investing. We co-sponsor these events, and we've been doing this now for real close to, is it 11 or 12 years now, Mark? What are we coming up on, our 11th anniversary?
12 years in July.
We're coming up on our 12th anniversary, so we're close to halfway there. And we especially give a big welcome to all the folks from Mid-Michigan that come to these things. And then, of course, we're always grateful that you folks from outside the chapter feel that this is worthwhile enough to join us for an evening of discussion and debate and dad jokes and everything else in between. So.
And we also would like to welcome fresh from the baseball field, Cy Lynch. Good evening, Cy.
Good evening, everybody. And of course, we're thrilled with the Braves, as you mentioned, and I'm sorry to have missed you last month. But what I really want to say tonight is go blue.
Well, that certainly puts a damper on the evening, Cy. I'll tell you.
Oh, yeah, that's really kind of driving it home, isn't it? I don't know. We may not have a Big Ten team in the Final Four this year, the way things are going.
Maybe the conference is just too good, Mark. They just keep knocking each other off. So,
all right. Do we have Hugh with us yet? He was going to try and join us tonight. I didn't get a chance to check.
I think I saw Hugh.
I'm here. I don't know if you can hear me.
We can hear you just fine, Hugh.
Okay, good.
Well, greetings, Hugh.
Yeah, I had just a bit of hassle getting in, but here I am.
Okay, well, the slide is a little bit of a tribute to the warfare that's going on in the virus world with Omicron and everything else. Maybe after your Amgen session, you can give us a little update on things that are going on. There was a little Ardelyx news today, to the extent that you can talk about it. But let's go ahead and get underway unless you guys have anything else you want to point out.
No, I'm not even going to say go Bucks tonight. Okay, so let's go.
All right, very quickly, a lot of familiar names in the audience. Welcome back. Those of you that may be new, we do keep it fairly informal. You can submit questions through the questions tab, or we generally don't raise hands, but we do open up the floor if we have a little bit of time left over at the end. So we will try to get to that. This is all about education. Everything that we do here is for illustration and demonstration with bold that up and underline demonstration. What we're basically doing is taking the philosophies, practices, techniques, methods of analysis, etc., basically promulgated by the modern investment club movement, whether it's through the work of the National Association of Investors or as interpreted by us at Manifest Investing. We basically think that buying excellent companies when they're on sale is a really, really good strategy. And that's what we try to demonstrate here. So you'll hear opinions, but please, please, please do your homework before making any type of an investment decision. Make your own decision. If we hold a stock in our portfolios, we will try to remember to disclose that. If you'd like an email reminder of future roundtables, like Ken said, we are coming up on 12 years of doing this monthly. You'll see how well we've done here in a minute, but please send an email to nkavula1@comcast.net, and she will add you to a list. She will not inundate you with emails. You get a couple reminders that this event is actually happening. I know how useful I find the email reminders to let me know where I'm supposed to be and when. Good stuff. If you'd like copies of the slides, or if you have follow-up questions or suggestions, please send an email to markr@manifestinvesting.com. So let's roll. Here's the agenda. Basically, welcome everybody. We're going to talk a little bit about how well we've done, take a quick look at the portfolio. I don't think there's any glaring challenges, but we can kick that around. You see the 5 ticker symbols which will be presented tonight. We do a poll at the end. Even if you're here for the very first time, a big welcome hug to you, and you do get to vote. If you're from Chicago, you can vote 3 times. Not really. But then we do try to leave a little bit of time for open Q&A. You can see the companies there on the right. So let's keep rolling. We've been doing this since July 2010. We're attempting to share one of our favorite current actionable studies that you can look at. And again, we're demonstrating the techniques of the Modern Investment Club movement. We like to keep track of how well we do. The objective has been to beat the market by 5 percentage points. We define the market as basically the Wilshire 5000. And we do like to see over half, hopefully 60%, but that's proving fairly elusive, of our selections actually beating the market. Actually, one of the things that we do prove, we could actually have as I would say, we could do an hour on this alone. You don't have to be right 80 or 90% of the time. If you're right half the time, as you'll see here, you can still achieve an 18 or 19% rate of return on your investments. All right, here is the actual specific performance over these last, like we said, we're coming up on 12 years this summer. The rate of return right now sits at 18.3. That may have actually gone up a little bit with our Ardelyx today, going up 35%. We've got 7 positions in our Ardelyx, so it went up a little bit. The Wilshire 5000 using mirroring investments has gone up 14.6% per year. So it's the top one minus the middle one there, gives you that 3.7 percentage point return. That is what's graphed here. It's literally the answer to the question, how much is the tracking portfolio beating the market by? And you can see that we actually got up in a very enjoyable 8 percentage point range there for a while, but it's still pretty solid over time, and we hope to return. Any comments or questions at this point, Ken?
I just continually amazed when I look at this graph, Mark, to beat the market over this long a period of time by more than 1 or 2 points, I think is a phenomenal achievement. Of course, I'd like to see it back above that +5 line, but I'm pretty happy with 3.7.
And for those of you out there that may be unfamiliar with the Modern Investment Club movement, and it's basically goal setting and objectives, one of the objectives is to try to beat the market by 5 percentage points. That would be that red dotted line. And we can point to a number of clubs that do that. And those that fall into that 0 to 4% range, that's also pretty good too. You end up in that range of, you end up on that graph, you're doing fine. All right. Here's the tracking portfolio. You can actually access the entire tracking portfolio. These are the top 20 stocks. The entire portfolio can be found at this link. And that's a public link. You do not have to be a Manifest Investing subscriber to access it. It's a public link that you can look at. The way you read this chart, these are the positions in the portfolio ranked from the largest down to number 20. I think there's about 70 positions in the total portfolio right now. Like I say, you can see the whole portfolio at that link. And the way you read this chart is, for example, Microsoft is currently at a value of 83, hard to believe, huh? $83,832, and it's actually only been selected 5 times. Every time we make a selection, whether it's a knight, a damsel, or an audience poll, we invest $1,000 into the position. So $5,000 invested into Microsoft is now worth almost $84,000. So Hugh and Ken, take a bow. That's actually going back 8 or 9 years for Microsoft, I think. EPAM Systems, oh my gosh.
Well, not only EPAM, but Psi, Cognizantology, Lynch. So
Yeah.
both of those stocks we have courtesy of Psi Lynch in the portfolio right now.
Yeah, he's the information technology beast for sure. Ken is actually going to be bringing this one tonight, so you can see that it will be a repeat selection. And it's a 4-time selection, checking it at 18. And he'll tell the rest of that story, but you get the idea from top to bottom. The ones that really give me a pause, Costco Wholesale is a 1-time selection by Hugh 10 years ago.
Well, and that Amazon selection is a 2-time selection, Mark.
Yep, this
up there in 4th place. Yeah.
That's a
So that's only $2,000 moving to almost $24,000.
So there's some good ones on there. Kim and I have some good ones on there too. I think Kim was a bunch of LGI homes and Booking was one of Ken's favorites, and Regeneron was one of mine. It's just good stuff. It's good fun. It's an interesting demonstration of people with completely different styles generating this type of result. Anything else you want to point out, Ken?
No, you can. I love lists. Well, you know that, Mark, and I could sit with this dashboard and come up with all kinds of interesting facts and figures, but I don't know how interesting they are to the entire audience. So let's keep on moving, okay?
All right. Why don't you do a brief report card for us tonight, and then we'll try to towel off Cy and calm him down because he's going to want to fix this rapidly.
Well, that my par number up there in the upper right-hand corner represents what an average stock in the database would be giving us on a yearly basis for the next 5 years. That's about 9%. If this were a very average time in the markets, that number would be a little bit closer to 10. So that number's been as low as 5.5 and as high as maybe 16 or 17 within the last year and a half. So it does move depending on the whims of the people that are investing and what becomes popular and what does not become popular. And without that kind of volatility, there would be no market and there'd be no way to really put together a portfolio that could appreciate. Our par is 10.9. That's 2 points above my par. We'd love for it to be 5 to 10 points above. That's what we call the sweet spot. Nicholson said try to beat the market by 5. He also said it's almost impossible to beat the market consistently by more than 10. Hence, the 5 to 10 is where we'd like to keep our portfolios if we could. This is not an individual stock average. This is the average for the entire portfolio. Quality at 86.9, that's in the upper quintile. That's a real high quality portfolio. And in fact, I think that as you move closer to corrections or difficult markets, you tend to lean a little bit more on quality even than normal. So I'm looking in the next couple of months for people to be looking at some pretty high quality issues to talk about adding to the portfolio. Nicholson also suggested that growth in a portfolio that was going to be growing at the rates that we were aiming at should have sales growth somewhere around 11.5 to maybe as high as 12.5 or even 13% sales growth. And our sales growth is pretty decent. For a while, 4 or 5 years ago in this experiment, that sales growth was down around 6, 7, 8%, and we made a concerted effort to boost the sales growth. And as that went up, so did our par values. We also would like to see the last 2 numbers in the averages, the financial strength and the Eps stability, stay at least at 75, and I would prefer to see them even at 80 or better. Financial strength is pretty self-explanatory. You have a real good feeling for what that means. Eps stability, think of it as how straight and how reliable is the earnings line on a visual analysis. The straighter and more reliable the earnings, the higher that number will be when you're doing the calculation. We have a number of stocks that are sitting at the bottom of the par list. We tend to look at the bottom, and we have some discipline about selling. And some of that discipline is that when a stock that's a core holding moves to a par that you could get with just cash, you might consider selling it. When a non-core stock, and I'm looking at this list, and maybe the only non-core stock, maybe I see two of them, Mark, at ASGN and Forward Air. Those might be non-core holdings down there at the very bottom, but the rest of that list is definitely, in my mind, core. None of them seem to be challengeable enough, except maybe NVIDIA. When a non-core stock moves below the average, I'll circle around again. The average is up in the upper left, 8.9%. We have two non-core holdings that are under that average. We might consider moving them out of the portfolio. Now, in a tracking portfolio, we're not going to replace that cash. We're just freezing the position with whatever it happens to be at the moment it's frozen, and it will stay that way as long as we keep the tracking portfolio going then.
Yeah,
So have I forgotten anything, Mark? Oh, I haven't talked about the bottom. I'll let you talk about the bottom down there, Mark.
Yeah, the one thing with NVIDIA, and it's actually a George Nicholson piece of advice, is anytime you're dealing with a rapid growth company, and NVIDIA is certainly in a very powerful industry, you want to think twice, maybe three times about selling it. It's actually down at that point. The counterpoint to that is, I mean, even EPAM, as sacred as that is, we've even talked about naming some of our children after EPAM here recently. Okay, grandchildren, sorry. Even EPAM has come down pretty significantly from where it was, and we had scratched our heads over possibly selling some of it a little while back. So yeah, it's always tough. The two things at the bottom, oh, my Madden pen is going crazy here. The two things at the bottom, the rule of 5 is a reference to any time a stock mysteriously misbehaves versus the stock market, and it basically trails by minus 20% or worse. And we've got a couple there that fit that description, A2 Milk and Ardelyx. They're just misbehaving pretty badly. In fact, they're so far off the scale that we've decided to kind of let them run and see what happens. The position sizes are actually fairly small, and we're just kind of letting them run. Jazz Pharma and Universal Health are two that also are kind of in that range of they're just not behaving very well, at least not yet. And then last but not least, with a relative strength greater than 80, Costco has been red hot. And I still would, I'm not thinking that we have to panic and sell Costco. I think if it were to get to minus 2.8, maybe, but it's just a trigger or a signal that it's extra hot. Am I still on? I had a bit of a warning sign there.
You're still on, Mark. I can hear you.
Okay, so let me just kind of go through a quick look at NVIDIA.
I just wanted to say, if this, I tend to think, since we do track our performance against the market, we do wish to do some portfolio management as opposed to just looking at individual stocks. But if this were a fully managed portfolio, we would strongly, and I just want to make this point for people who are running in your clubs and your individual stocks, you should be looking at selling, starting at the top with NVIDIA, Costco, Adobe, Pfizer, and into that sacred EPAM potentially, because otherwise you're never going to beat the market by 5 percentage points if our projection stays at 2 with a big chunk of the portfolio. Me personally on this, I don't know where the dollars would fall. I just kind of went in reverse order there. Given the market right now, I'd be kind of looking NVIDIA just because it's negative. Pfizer, it's in the average Quality side, so I'd be looking maybe to trim it. Also notice it's a 2.9% growth. Schwab is just in the average area, but again, it's just a 4% growth area. And realize these comments I'm making have nothing to do with the quality of the company or even the appropriateness of the company maybe in your portfolio. But in this portfolio, these are the lowest par companies, and you would want to bring that par up.
Mm-hmm. And we actually have worked at that.
I'm going to double down, Mark, on what Cy said, because we have a couple of really small holdings sitting in here that, there's nothing wrong with moving them out of the portfolio. They're not going to contribute that much if they just really wildly take off. And at the same time, I really think that Cy's right, that we should be demonstrating some of the management. I also would like to give Universal Health a timeout. That was the stock that I brought to the round table. I also own it in one of my portfolios, and I cannot figure out what the problem seems to be. This is an owner of hospital, psychiatric care units, things like that. And I just can't, for the life of me, figure out why it's not performing better than it actually is right now. I would say the same thing about Jazz. I'm very disappointed in Jazz Pharmaceutical and can come up with no real reasons why it's underperforming as much as it happens to be. If Cy's making a motion to go NVIDIA through Pfizer, I would go with him, even though it takes the sacred, it takes four stocks that I think are extremely high quality and great stocks to have in the portfolio. It takes and moves them out. But I'll let the other two people speak as well. I'll let you speak, Mark. What do you think?
Well, I think Hugh could probably back me up on this one. Jazz Pharma is in the middle of a fairly substantial merger. The other company escapes me, but it's not going, at least by perception, as well as people would like. Any comment on that, Hugh, when it comes to Jazz?
Yeah, I think that kind of sums it up. I'm a bit distracted right now.
Yeah, and it's showing, and I guess the only exception I would make to that is Costco is such a long time holding. I am emotionally attached to it. Hate to sell anything when it's above money market rates, when it's truly a core holding. But maybe if
well, we might go at it then, Mark, from the Pfizer Schwab viewpoint and sell the two with the lowest sales growth.
I'll trade you one ASGN for one Costco.
Well, I'm reasonably certain that I don't have any problems getting rid of ASGN, and I know I don't have any problems moving Forward Air out of the portfolio at this point.
I'll tell you, this really is tough stuff because I, in the 10 cup portfolio, we run a demonstration portfolio at Manifest. I had both of these, and they both were just smoking hot, and made the very challenging decision to walk away from them. And EPAM, I don't remember the dollars, but it's come down substantially from the peak that it hit a few months ago. You can go back and look at the transcripts. We actually talked about selling EPAM and didn't do it, or even part of it, a couple months ago. So I'm thinking we could probably jettison Jazz, Universal Health, Adobe. Pfizer's a tough one too, but it's such a small position. Plus, he's going to replace it with Amgen anyhow, in ASGN, and just take it from there. And that gives Cy his pound of flesh. That's at least an effort to work on my par for a bit.
I'm going to only give you one statement about Adobe, Mark, that would, for my mind at least, give me a little bit of reason why I might want to keep Adobe, and that's the fact that they spend almost 17% of their revenues on research and development. Now, this is a software company spending huge amounts of money on research and development. with a already almost insurmountable moat around it, I just have to think to myself that this company is banging it right now, you know. So, but if you think it's for the best, I'll go along with you.
We'll give it some consideration, but all right, I'll tinker. I'll sell a few things, and we'll see what it looks like next month.
Okay.
All right. One other point that I wanted to kind of give tribute to Nicholson and his concern about being careful with a company like NVIDIA. Anytime you've got a growth rate as high as this, it's those numbers can be misleading. This is actually from one of the bull sessions we run on Tuesday afternoons, just demonstrating a fairly long-term look at the company. So there's the sales growth, again, high teens for sales growth. The stock price has been red hot. It's been red hot for a long time. It's been overbought much of the last 6 years. So you can see what's going on there. Notice how the earnings have stabilized and are looking pretty good down there on that bottom chart. So, you know, we tend to throw these on the evaluations scale at some of the bull sessions. And then this is the one I would leave with, because this is probably one of the most challenging aspects of thinking about a company like NVIDIA. I don't know where the plateau is on profitability, but they're certainly chasing some pretty high numbers on the right-hand side of that chart. And you start factoring that in, and you look at, again, this projected return on value, which we'll talk about a little bit here more for a second. You take the PE out of the equation a little bit, or at least subdue it a little bit, and you are left with a slightly different look. And it's not an automatic sale, is what I'm basically saying, based on the projected return, because that PE can be very, very difficult to envision. So just kind of lay that out there. Again, the advice being, anytime you're dealing with one that looks like that, Nicholson said, just be slow to sell. You know, take your time, consider it, and really, I don't think it's being wishy-washy or stubborn. Just recognize that the only way you get a 250 bagger in a stock like Apple is you hold through some of this type of stuff.
NVIDIA, Marco's also a poster child. If you go to the next slide, back one, if you go to this slide, you look at the RSI graph at the very top, NVIDIA is a poster child for why you don't just automatically pull the trigger and sell every time the relative strength goes above 80. That's that shaded part of the graph, and Mark's correct, for large sections of the last 5 or 6 years, NVIDIA has been in a zone where you might consider selling it, but you know, compare that long sales in 2014 there to what it did after you would have sold it, and it maybe makes it a little bit less automatic about getting rid of these companies when that RSI goes above 80 for a company that's growing at 18-19% over long periods of time.
Yeah, and we talked about a massive drop in Apple back in the year 2000 as another example of how sometimes this can be a pretty tough situation. Now, what I will say, and Cy already talked about this a little bit, for either individual portfolios or investment club portfolios where you're taking care of a more focused, a smaller number of stocks, anytime you have this type of formation that you see here with the high relative strength, I do think that moment in time is a time to think about, is it too high of a percent of total assets? Or what's the overall portfolio look like? Could some skimming or trimming be done? So that is a valid thought. And the reason being, we should not be surprised by when you do have these peaks in relative strength by either a plateau or a dip to the downside. Doesn't always happen, but you shouldn't be surprised when it does. And they can plateau for a long time. Like Cy talked about last month, Home Depot could plateau for 3 or 4 years, over the last 40 or 50 years. So that's just out there for what it's worth. All right, I have 9 o'clock, so should we go ahead and roll?
We should try to roll, and let's all try to keep ourselves disciplined and stay to 7 or 8 minutes if we can for our presentations.
Okay, I will try to go pretty quickly. Got a little bit of content here to get through. I do like to show where my ideas come from. We're spending a lot of time with Joel Greenblatt, this concept of his called the magic formula, which in my opinion is just better investing, because what Joel Greenblatt is looking for is excellent companies at good prices. Sound familiar? And the way he does that is he looks at the earnings yield, which is just the PE flipped upside down, in combination with return on capital. And he basically goes out there and looks for pretty good companies that have a pretty good return on capital. And he had massively good results with this approach. And I think it's just basically the same thing. So what you're looking at here is companies that we consider to be excellent quality by our definition, looking for double-digit returns in both par or projected return on value. And then he throws one more at it. And here you're going to like this one. That little snippet down to the lower right, he basically challenges the students in his MBA classes to come up with a bunch of names, and they write down the 52-week highs and the 52-week lows of all the companies, and then they average them out and basically show how much of a variation you have in any one calendar year. And I credit you with basically reminding us about that. You can take some of the risk out of investing by investing in companies that are fairly close to their 52-week lows. That's what you see here. Anytime you have a company down around zero, in this case, today, these four companies hit new 52-week lows. That's why those numbers are red. So we're drawn to all seven of these. Pretty good relative strength index, just the opposite of what we were talking about with NVIDIA. These are oversold and possibly bargains. So Activision Blizzard, America's Car Mart, Biogen's kind of an interesting one, a little bit of dissension from the analyst consensus here, but pretty good outlook for the year ahead. Pretty good numbers across the board. I kind of flipped a coin and went with Activision Blizzard, mostly because I wanted to play around with animated creatures on the slides. Not really. I'm kidding.
Yes, really. Go on.
I did want to point out on the upper right there, this approach to investing is covered in that book, the little book that still beats the market. It's actually from 2010, and it actually hasn't done quite as well. The method hasn't done quite as well over the last few years, but we'll talk during bull sessions about some theories about why that's the case. All right, so the company I chose is Activision Blizzard. I'm not a gaming person. I've done a little bit of it. I respect it. I know Ken has done it with the grandson. Our son does it. I mean, I pay some attention to this stuff. One of the things that I will never forget was Alex's, I believe it was 13th or 14th birthday party. We had 7 or 8 young men here at the house, and I had a couple of the projectors from the office, and we projected them on the walls of the basement. So we had like 4 or 5 different theaters where they're all playing the games together, and they were playing a form of this Call of Duty or whatever it is, and Alex basically said, "Wow, that's the best birthday party in the history of man." That's how much fun it was, and anytime I see that, I know that they've got something here, and they are the makers of World of Warcraft and Candy Crush, which I think is Natalie addicted to Candy Crush, Ken?
No, Natalie doesn't play a lot of games, so.
Anyhow, they've got some formidable games in the marketplace that I don't participate in that much, but good, clean fun. All right, here's a look at the company using some of these concepts that we've been talking about during the bull sessions, and here over the last little over a year since Hugh and I first started talking about Tesla. It's just a reminder that going back to the very first stock selection guide published in Better Investing magazine, and that's what you see on the left, Mr. Nicholson basically wanted us to place a whole lot of emphasis on that top line, understand the sales trajectory, and also pay attention to the profitability, in this case measured by Section 2A and the projected pre-tax income. And you're basically trying to chart out those two. There's your up, straight, and parallel. This is kind of the way that he suggested that we keep track of the companies and regard the companies that we are studying. Here's a closer look at that operating margin, because on the previous slide, you can, if you squint at it, you can see that the the trend for profitability is actually approaching the sales, meaning the income or profitability is actually improving, and you see that right here. The Value Line analyst in their most recent closing paragraph likes the outlook for the company over the next 3 to 5 years, and they earn pretty high marks. Here's the stock price chart over the long term, and you can see that they also have had NVIDIA-like characteristics. They have been overbought a number of times with that relative strength index, the RSI being up and shaded, as Ken was pointing out. Again, after a long run like this, we can't be all that surprised by something like that. It will happen. Flat spot or dive. It's going to happen. Here's a look at what has happened over the last year or so. And they have stumbled a little bit. They've had a little bit of a breach. They made some adjustments in expectations here that resulted in that. They probably said we're going to earn 84 cents instead of 85 cents, and the market panicked. That type of thing. I don't know the actual numbers. I'm just throwing numbers out there. Anytime you have a red circle like that where the earnings drop down, guess what? Stock price follows earnings. And so we're looking at a company that has lived in the 20s for PE ratio. So that's all well and good. That's actually a pretty good earnings trend, pretty high earnings per share stability for a company like this over the long term. The outlook for next year and the next few years is actually quite strong. And I would argue that it's been pretty good, even while it's been getting beat up. Again, referencing that long-term price chart, it's been getting beat up, but the operating results don't reflect that. All right, so here's a look at the company with everything on the page, and I'll just kind of walk through it carefully. Again, the visual analysis on the right is the reminder, up, straight, and parallel. We're talking about a company that is selling for $58.60 that has a relative strength index that is definitely in the oversold condition. The projected annual return based on the assumptions we're going to see down below and the projected return on value are in the mid-teens. Very high quality ranking. It's an excellent company. $9 billion company growing at 8.9%. That's the trend line that you see over here. So it's projected to be approximately a $14 billion company 5 years from now. A projected operating margin, Value Line says 44 or 45%. I'm more comfortable with 40 based on that picture that you see for the operating margin. So we're basically looking at between $5 and $6 billion in operating income before taxes 5 years from now. The assumptions that were made for the projected annual returns, basically section 5 of your stock selection guide, were a projected net margin of 33 and a projected PE ratio of 20. Again, looking at that picture, 20 makes sense to me. I'm okay with it. I find it interesting that they have more cash than liabilities. More cash than liabilities. That's something that is reflected in the projected return on value, and it's an important aspect of the company. What debt that they do have has a very low effective interest rate, basically tells you all you need to know about the true financial strength of the company. I don't care whether A, B, or C is thrown at it by Moody's or Standard & Poor's or anybody that does those ratings on the street. The number that I care about the most is what will the bank loan money to them at what interest rate? Basically just like a mortgage. So their credit rating is quite good. Again, they actually dipped below their 52-week low. So he who likes that, I like it too when it's down in that range. The target price is as high as 125 for the 52-week outlook. So they are in position there. Value Line likes it. It's got a double-digit low return forecast. And you can see that even Morningstar is kicking in with a price to fair value ratio of 60%. Anything below 100 is potentially on sale. And 60% actually might be getting a little bit too much on sale. So with that, I'm going to go ahead and play a little video game and add Activision Blizzard to our collection. All right, Cy, would you like to take us away with Ollie's Bargain? I'm pretty sure you can probably buy some video game stuff at Ollie's.
I would suspect that you could. Certainly anything that is tinged just a little bit with overstock or whatever, since that's what Ollie's does. Here's the relatively up straight and parallel. You'll see a bit of a hit in the latest reported quarter for Ollie's. I'll just mention there's two basic reasons for that. They report earnings on Thursday, I think. So we'll see what happens with the third quarter of should be 2021. Yes, 2021. I was looking at the wrong place. But the second quarter of 2021 shows down a little bit. First of all, a very unfavorable comparison to the second quarter of 2020, coming out of the shutdown for the pandemic. And also they are suffering some of the infamous, if you will, supply chain issues. Again, Ollie's, you can tell here, value line likes it both for the 18-month period as well as the 3 to 5 year periods. And by the way, that's just about, value line was about 2 months ago, but the stock price is right in line yesterday and today with where it was when value line had those projections. So those are still pretty valid. And notice it's selling near the 52-week low, which we'll see in a moment. Next slide. Here's where I got it from. There's a screen that I developed a few years ago. I call it the middle growth value screen, and it's just taking mid-size or middle growth companies growing between 7 and 12%, and then looking for excellent quality. You can see the criteria there at the side, and you can see the that Ollie's came in fourth on this list. You see Activision Blizzard there. I didn't really want to do a video game company and take Mark's thunder away, although I didn't know he was picking Activision at the time. I also wasn't in the insurance mood for tonight. Global Payments was a little pricey on the PE side, so I decided to go with Ollie's bargain. And you'll notice on this slide, it is within just under 10% of its 52-week low. That's the fifth column, I guess, over marking it right now. So that's what that screen is doing for us as well. Next slide.
I just want to make the observation that we didn't talk about the 52-week low thing before the session.
You're right. We did not.
No conspiracy here.
But it's coming together, isn't it? A quick industry study. You see, I like to do my industry studies frequently ranked by quality. You see that Ollie's is top, although all four of those blue companies are very high quality, yet the returns are not as good on everything in the industry except for Ollie's. So Ollie's right now is the best value in the industry and excellent quality. Next slide. A couple of just slides on who Ollie's is, what they are. And this is pulled out of Ollie's investors presentations. They're a large retailer of closeout merchandise and excess inventory. They run a little bit in the realm of Tuesday mornings, if you remember Tuesday mornings, except a much wider range of product, and kind of in the realm also of Big Lots. Again, a bit of a wider range of product than Big Lots. They're in 27 states, and Ollie's likes to take themselves lightly a little bit. You see good stuff cheap up there at the top as a slogan. They call their store semi-lovely, and they sell closeouts, overstocks, etc. Next slide. This is where the products come from. They buy directly from the manufacturer sometimes for seconds or overstocks and the like. They also buy from financial institutions who end up with inventory through liquidation. Again, that's unlike some of the other discounters or outlet type stores. Ollie's tends to buy complete stores or companies. And that's why their product range varies so much and is so wide, as opposed to perhaps some of the other companies that say, hey, I'll buy all of your video games out of your stock, or all of your TVs, or all of your furniture, or whatever it may be. And then they have a 30-day guarantee. Next slide. Here basically is their formula for success, that they say, I won't read all of these things to you, but they like to encourage their customers to look at it as a treasure hunt experience. The inventory is changing over time, so keep coming back to see what maybe you can find as bargains today. And that's also mentioned in the Good Stuff Cheap there underneath the treasure hunt that I mentioned. They also, perhaps the key to the long range buy proposition for Ollie's is that they're in 27 states. They've got a lot of room to expand within 27 states, as well as the other 23. So a lot of, as the company puts it, white space that they can grow into. They're a little over 400 stores now. They're shooting for at least 1,000 and perhaps more in the next 5 to 10 years. Next slide. Here are some of the brand names that you'll find potentially at Ollie. Again, the assortment of products changes so that it appeals to many people, and again, feeds into that treasure hunt experience. Come in and see what bargains you can find today. Next slide. Again, just more talking about the brand names and so forth that they utilize or that they stock, and noticing again here that they seek to be humorous and attract customers through their humor, somewhat even self-deprecating a little bit humor. I'm not reading the questions closely, but I do notice that there's a question about potential lower income shoppers. Actually, Ollie's is a bit more seeking the higher income level of shoppers than you would think would frequent a discount store because of their product mix. They stock more higher end goods than, again, say a Big Lots would. Again, closer to a Tuesday morning in some of their items, and they also stock a lot of furniture and the like. Next slide. Here are my judgments for Ollie's. I project 11% growth, and then the pre-tax profit margin of 12 works out to a net profit of right at about 9, roughly in line with Manifest's consensus, I believe, and giving us a $4.64 projected earnings. Next slide. And then using a 27 average PE gives a par or an average potential return of 14.7, which is a little below the Manifest consensus right now that you saw on the screens earlier. And then if it hits the high PE of 39, could return around 23 or so percent. So I'm adding Ollie's to our portfolio.
Cool. Thanks. So I need to go on an adventure. Do we have one of those around us, Ken?
We have one up in Flint. I don't know about you down in Rochester there. You're in a pretty high class neighborhood down there, Mark. So you have to travel up to Flint to see one. Okay.
All right. It's a date. All right. Kim, are you still with us?
I am.
Well, take us away on PayPal, one of your longtime favorites. You first brought this to the portfolio a few years ago, right?
I brought it, I believe, right after the spinoff when it was $49, I think.
Okay.
Or I brought, or the next time I brought it is in 2014 when they had that lovely price drop. Because as an investor, I really enjoy volatility as being my friend. So you could see how here we have up, straight, and parallel when you're looking at the visualization of it. Also, you could see, if Mark, you can circle that red line where the stock price is at now, at the very bottom of the price bar. So that's one of those things that I also like. I can tell you in the most recent quarter, they have 416 million active accounts. They have 4.9 billion transactions, 310 billion total payment volume, and the payment transaction per active account has increased 44.2%. 44.2, it says payment transactions per active account. So they're doing everything right. It's just that the stock price really got way ahead of itself. Next slide, Mark. You can see where the stock price got up to over 300, and I knew it was overvalued, and I kind of, like what Mark talked about earlier, I really don't know when the stock price is going to go up, when it's going to go down, but I always keep an eye when it goes down. As you take care of family, you sometimes recognize you don't have time to do anything. You'll notice here the recent price was 246, and it closed today at like 186. So it has had a nice 60% drop, $60 drop. And if you can see here the RSI, this is where we also get very interested. Our RSI is below 20. Fundamentally, what do we all look for? Is there anything wrong with the stock? Well, the market is punishing this stock because, back to the Pinterest, they had talked about pursuing buying Pinterest. Well, they decided they didn't want to. And so the stock got majorly crushed. Now, the other thing is if anybody is watching Visa, MasterCard, or Discover, these are all payment processors, and because of the variant that's out there now, the volatility with these stocks is continuing because people don't know, are we going to get shut down and locked up again? So that's another really benefit for us. And the other reason is people are very concerned because they're ending their partnership with eBay, because this was a stock that was spun out from eBay. Well, what most people are not seeming to recognize is that it has been already announced that you're going to be able to use your PayPal and Venmo on Amazon beginning in 2022. Well, I think that's great. That's more transactions, more cash. And we were talking about inflation and what is it going to do to our stocks? Well, I like, specifically for myself personally, my own judgment, I like having stocks that have lots of cash on the balance sheet, and this one has $20 billion of cash on the balance sheet, little to no debt, but their debt is $8.9 billion, but they could pay that off out of cash. And how is the free cash flow? You look at the free cash flow, you can see how the value line here says in 2020 it was $4.60, $5.35. I think next year $5.95, but going forward $7.45. So that's almost, if you compare that to 2020, that would have been like $9.30, doubling. And so it's not quite going to double in 5 years, but bottom line is they got lots of cash. So if they want to buy another company to acquire to help expand their network, they can. And they did just buy PAIDY. It's a company out of Japan that has the pay now, pay later that everybody is going to. So they are expanding geographically, which even makes it more so. And a lot of people don't realize they were one of the first just to expand into cryptocurrency. And now you can see here on Manifest, the quality is 94. That just went up a big bit because of it, the recent spinoff, and it's been post 5 years, and it has a par of 9.6. And I will admit, this is one of my core holdings. I just kind of, whenever I have a nice big fat dip, I add a few more shares, because the sweet spot for me in this stock will be that all that free cash that they have is right now, if they're using the free cash for more acquisitions to incorporate other companies that they can do transactions on, is great. But there's going to be a point in time all that cash is going to be sitting there, and they're going to start paying dividends. And I, at a retirement age now, I do like my dividends. And also look at, this is a company who has a net profit margin of almost 24%. That's nothing to be complaining about. So yes, the stock price has dropped from about 305, I think it was, and it's down to 186. Guess what? 184. To me, I really like the stock. I own it, full disclosure. And so take a look at PayPal. All right. Thanks, guys.
You be accumulating. All right, Ken, take us away with one of our old favorites here.
Well, I'm coming back to Universal Display Corporation. Next slide, Mark. I came up with this choice by taking the roundtable portfolio, and Mark showed you earlier how you could access the same portfolio. I sorted it by par, a real simple one-click sort, and then I like to look down right at the top of the sweet spot. That's 10 points above the average return. The yellow background means it's slightly more than 10 points above the average, and I kind of look at above and below. I didn't like the idea of A2 Milk, and I didn't like the idea of United Airlines.
That's blasphemy. Blasphemy.
I know blasphemy, but I had been pushing housing stocks for quite a few of the previous roundtables, and that would be Green Brick Partners. So the next one on the down part of it came to be Universal Display. I happen to own the company. I like the company a lot, and I know that its stock price has cratered in the last 6 months or so. Next slide. I'm going to tell you that this is a pretty high quality tech company with a lot of technical language to explain what they do. They seem to have one of the best investor relations presentations from a tech company that I've read in a long time, because they take, and in about 35 slides, they bring the language down to good, simple, understandable English, so you get a real good feel for what an OLED is. It's an organic light emitting diode, and that's nothing more than some thin organic films. Organic materials are materials that contain carbon, and they don't come out of the ground like copper and aluminum and iron would come out, but they're compounds. And you take some of these films, these organic films, smash them between an anode and a cathode. That's a positive and a negative end to an electrical current, and they will glow if you use the right stuff. And the glow can be made in red, green, and blue. That allows you to get almost any color under the sun. And what's nice about these organic diodes is they can be flexible and they can be made transparent. I would urge you to go to the investor's presentation if you're interested in this company and take 15 minutes and read through it yourself. You will learn an awful lot about the company in a relatively short amount of time. Next slide, Mark. They're using this universal PHOLED technology to put a current through these organic films. They call them phosphorescent emitters. And what comes out is light and virtually no heat of any kind. Compare that to an incandescent bulb, for example, where you put an electrical current through tungsten or some other metal, and you get a lot of light, but you also get a fantastic amount of heat. Compare that to even traditional LEDs, where you still get enough heat that you can feel it with your finger. These OLEDs give you virtually no heat of any kind, which means they are very energy efficient. And on top of that, these are very inexpensive to make when you compare them to traditional LEDs. Next slide. There's a lot of things driving the market, but the biggest thing driving the market is that when you add these three organic layers, this red layer, this green layer, and this blue layer, you reduce power consumption by 25% with just the red layer, up to 45% with the red and the green layer, and up to 75% with all three layers. When you do that, and when you reduce the power consumption, you make these things operable on a very small battery, and you almost completely eliminate wiring in any way, shape, or form. The batteries have to be very low power batteries because you don't need a whole lot of power to make these things run. Next slide, please. Here they are being used in smartwatches, in all kinds of phones. I found my phone on this list. My Google Pixel 6 is using OLED smartwatch technology. Next slide. But they've also moved into televisions and all kinds of displays in modern automobiles. If your grandson or granddaughter has a Nintendo Switch, that's an OLED panel that they're using. All kinds of computer applications. Next slide, Mark. And you can start to bend and fold these OLEDs because remember, they're very thin and they're transparent. So you start to get flip fold phones again, only this time the screen is actually folding, and you get all kinds of shapes that you could never put together in traditional LEDs or in traditional liquid crystals. Next display.
Hey, Ken, I'm actually wondering, can I just circle some of these and send them to you as my Christmas list?
No, keep giving me slides. Here's a diagram coming from LG, which is one of the largest users of these screens, and it's showing you the simplicity of the, on the right-hand side, of the OLED screens compared to what you have to put together to come up with some of the other TV screens, hence the difference in weight between the two television sets. Go to Best Buy someday and try to lift up a liquid crystal display screen and then find an OLED screen of the same size and lift it. You will be flabbergasted at the difference in weight between the one technology and the other. Next slide, Mark. OLEDs are moving into regular lighting. Look at the different types of lights. They can put windows indoors that aren't really windows anymore. They're actually LED lights that light up at night and are transparent during the day. They can turn them into lights for automobiles or for almost any other vehicle that you could think of. And they could be extremely creative when it comes to lighting for any kind of building you might imagine. Next slide, Mark. This company is the giant in the room. They have a strong, broad, deep patent portfolio. If you read this slide carefully, you'll see that as of February 10th of this year, they had over 5,000 patents worldwide. You can see some of the categories these patents are in. They're projecting out to 2035 they're projecting that they will have at least 6,000 patents, and almost 3,000 of the current patents will have gone off patent by that point. In other words, they plan on growing the total number of patents even while patents that they own are going off patent and becoming general use kind of things in the marketplace. Next slide. The company summary, I'll leave it for you to read at a later time, but they have a pretty clear vision of how they're going to make money and how they're going to continue to make money. And one of the biggest pieces of that vision includes continued significant investment in research and development. Next slide, Mark. Here's the visual analysis. It was a pretty small company when I first discovered it back in around 2013, 2014, that time period. It's since grown itself to a medium-sized company, and I've circled the Morningstar analyst projections for the next 2 years of sales and the next 5 years of earnings. Even as a medium-sized company, you'll notice that it's still being projected to have robust growth in sales and earnings. Notice that it's also trading near or at its 52-week low.
Here's a theme.
Next slide. There's a theme. The last time I chose OLED, I came to the round table and was pleasantly surprised that Mark had chose the exact same stock. This was in April 2014. We put 2 positions into the round table, actually 3 because the audience voted for the stock, and we paid about $26 a share in 2014. At that time, I was estimating about 25% growth in revenues and earnings, and that number hasn't changed a lot, folks, even though my analysis has become a little bit more conservative. We also looked at average PE values of 30 at the high and 15 at the low. There has been PE expansion for this company, but I think you'll be pleasantly surprised that it hasn't shown PE expansion off into Never Never Land. At the same time that I put a position in the round table, my wife and I put a pretty good size position in our personal portfolio. We'll put 500 shares in our personal portfolio at $23.54 a share. You don't have to hit many home runs in an investing career to let your nest egg grow to a place where you don't have to worry about that nest egg too much anymore. When I put it in the portfolio, I labeled it non-core. My wife and I talked about the disruptive technology and especially the disruption that would occur in the cell phone and television markets. We also talked about the huge possibility of growth into markets that we couldn't even visualize at the time we bought it. OLED was averaging 26.6 in its pre-tax profit margins and had a return of equity of less than 10% in April 2014. I give you these numbers so that you can see what the company looks like today, 7 years later. Another click, please, Mark. Manifest Investing tells me that the PAR should be around 18% based on analyst consensus numbers. And it was selling, I think at the close of trading on Monday, it was selling at $146 and change. On September 2021, Value Line wrote this concluding paragraph. Now keep in mind that this paragraph was written when the stock was trading at just over $200. Even with the stock price decline, says Value Line, patient investors should wait for a better entry point. Well, I'm making the case that today is a better entry point. Next slide.
That's it.
That's it.
Good stuff, Ken. Thank you.
Thank you.
Sorry, Hugh, you've been waiting patiently for a long time, but I'm pretty eager for your update on Amgen.
Yeah, Amgen actually for patient investors may have a good entry point right now. Might get better actually in the coming weeks, as in lower. But I'm picking Amgen. I'll go through the process that I do once again. There's two spaces between process and once. Tut, tut, tut. Anyway, I go through this process of looking for companies near their 52-week low. Pure laziness, actually, because it's I don't want to lose. Ardelyx aside, I hate it when the company goes negative because I have to find cash to buy more. But I check out what I bought recently, and if the story hasn't changed, I will buy more. I check a lot of online resources, get a list of companies near their 52-week low, and then buy my favorite. And I've chosen Amgen. Amgen was way back when the very first company that I ever bought. So like Mark mentioned earlier, emotional attachment was generally a dangerous thing, but very hard not to have if you're a lover of good companies, and Amgen is certainly a good company. And all else being equal, as I said, I buy what I bought before. So Amgen was founded way back in 1980. It's hard to believe it's 41 years ago. It went public in June of '83. And at least at the get-go, it stood for Applied Molecular Genetics. That's where they got Amgen from. Genentech was Genetic Engineering Technology, abbreviated to Genentech. It hit its all-time low on right before Thanksgiving in 1984 when it was $3, 3.58 if you remember those days when things were traded in an eighth, and a few years later they were traded in the 16th. It had loads of splits since then, and if you had been genius enough to buy Amgen when it was $3.62.5, your cost basis would be just over 7.5 cents, as it had 48-to-1 splits in the form of a 2-for-1, a 3-for-1, followed by 2 2-for-1s, 3 2-for-1s. Pays now a quarterly dividend of $1.76. And I kind of was surprised when it started paying the dividend in the end of 2011. I knew it was going to happen eventually. It happened sooner than I expected. And the dividend back then was 28 cents a share. And now it's $1.76 a share every quarter. It may bump up at the start of next year for the payment in February. We'll see. And it is located in sunny Thousand Oaks, California. It is one of the few biotech companies that has reached escape velocity. That is, that it's an independent entity, a bona fide pharmaceutical company, just like Genentech and Amgen would be another one, and perhaps Biogen. Most companies get acquired. By the time people realized that Amgen was worth buying, it was too expensive to buy. A recent close, and this is a horribly big number, but it's $198.88, which is a fraction above its 52-week low of $198.73. Has revenues of almost 26 billion, but the earnings growth is negative right now, and I'll just chat about that briefly. Is a boatload of cash on hand. It's a highly profitable company with a 22% profit margin. Back in the day, 25 years ago, it had a 40% profit margin, just like Microsoft had in those days as well, when it was printing money. So moving along, you can see that the company hasn't performed spectacularly. It's now a middle-aged company, and it has that middle-aged spread. And unfortunately for companies, the middle-aged spread shows up in the share price, but it's paying the dividend, so you get some compensation that way. And it's paying quite a hefty dividend as well. The yield is well, it's climbed above 3.5%, I think, at this point, but it is close to its 52-week low. So moving along, Amgen has therapeutic focus in a number of different areas. Now, it is a classic biotech company in that, by and large, most of its drugs are what are called large molecules, proteins. These are challenging, difficult things to make and difficult things to copy. It does have small molecules as well, the proverbial aspirins of the world, these small organic molecules. It has some of those, but it made its money and continues to make its money selling large molecule drugs, proteins. And it's in cancer, cardiology, inflammation, and urology. And many of these names you'll recognize, Enbrel being its 800-pound gorilla, the elephant in the room, if you will. The revenues are eroding. Do we skip along to the next slide? We can look at how profit, or at least in terms of revenue, how much revenue these drugs generate. Enbrel, which is a competitor of Humira, it's priced around $1,200 a dose. It generates $5.2 billion in revenues. That's pretty stable. Amgen has a 7 or 8 years left on its patent. There are what are called biosimilars, or if you will, generics. They're called biosimilars in the large molecules on the horizon. But the interesting thing is that those biosimilars where they've been marketed in various countries aren't that much cheaper than the brand name drug. In the small molecule world, when a generic comes in the market, it generally is priced at 90 to 95% lower than the branded drug. So if you remember when Lipitor became generic and went on patent, it became extremely cheap. It's now fractions of a penny per dose to make. Back in the day, it was dollars to make. It was significantly more expensive. But it's tricky to make proteins, and the savings are not as dramatic as people would have hoped for. Eulasta, which I remember when that was approved 15 or so years ago, it's a white blood cell stimulant. It's about $6,000 per dose. I think it's for 2 weeks, and it's close to $3 billion in revenue. These are the two biggies in the portfolio. Of the $25 billion, about not half, but about 40% comes from these two drugs. Obviously, the red flag goes up when you see that, but there are good barriers to entry for these drugs, good reasons. Moving along to the next slide, we can look at the also-rans. You may know these. You've probably heard of Epogen, which was the first drug. Treats anemia, so it helps prevent sepsis showing up for people who are on cancer therapy. And this was the drug that was licensed to J&J. And if you remember back in the day, Amgen got into a huge argument with J&J, and there were lawsuits flying, and Amgen's stock went down and down. And it was a tremendous time to buy it if you got to do it, and those who did it certainly wouldn't regret it. And then so these drugs are doing well, very hefty doses. On the bottom, it shows the revenues generated by Aranezep, and Sensipar, but it's close to 1.5 billion. So it's a fraction, yeah, of the two biggies, but it is significant. And then Epogen, Prolia, and anyone can try to pronounce that one, Exgeva. Those drugs make up about 20 to 25% of the total revenue for the company. So skipping along, we'll look at just talk about the advantages that Amgen has. I said before, large molecules are difficult to copy. They're challenging to manufacture, and there is a much more stringent regulatory pathway to get approval for these drugs. So Amgen has good barriers to entry. Even when these drugs are marketed, doctors may be reluctant. Normally they're not, but they may be reluctant to start writing scripts for biosimilar, read generic if you prefer that language. But they are expensive, and as I said, generics don't really seem to save a lot. Maybe up to 10%, which is not, it's not insignificant, but it's not dramatic compared to small molecules. So skipping along, we'll talk about a pipeline. I think on the next slide. Or maybe not. Yeah, so its latest edition is this Crass inhibitor, which is very famous. This is the Crass G12C gene expressed a protein that everyone thought this protein would be a great target, but it's like a big ball of oil. And it was what's called undruggable. No one thought that they could get a drug to tackle this protein, but lo and behold, Amgen managed to do it and got approval first with Lumacras. And it has a competitor in a company called Mirata. If you've heard of that company, it's in San Diego. They should have approval for a competing Crass inhibitor coming up soon. It should sell close to $1/3 billion next year, so it will shore up some of the challenges in the pipeline from Enbrel, etc. And opinions vary as to how big this could get. You'll see anything from 1.5 billion worldwide to 3 billion. My expectation is that it could even be larger, because one of the benefits of adopting a Western lifestyle and everything that goes with it, the housing, the mortgage, the cars, you also get cancer as part of the deal as well, sadly. That seems to be the case. And as affluence spreads, so do diseases. So there is good and evil on the planet. And Otezla, you're probably actually sick seeing ads for Otezla, which was approved about 2 years ago. And Repatha, which is a cholesterol lowering drug, and a very interesting mechanism for doing that as well. These are drugs that are recently approved. Not clear how well they're doing. Otezla has a bit of competition, obviously, in arthritis, but they're advertising the heck out of that thing. So I mean, I was thinking of getting it even though I don't have arthritis. I just love the ad. Let's move on. And this was taken from a Seeking Alpha article from a number of years ago. I'd saved this. It just shows the breadth of the pipeline. It has a dozen or just over a dozen phase 1 drugs, about a dozen in phase 3. It has a very healthy pipeline. So even though the marketed drugs are under threat and under serious threat, there are replacements in the pipeline. Can we skip along to the next slide? That just lists what I just said. It also has a division working on biosimilars, so it's going to go after the companies that are going after it. I think, well, I don't want to misspeak here, but there are 1 or 2 of the major pharmaceutical companies with biotech divisions that are gearing up to make biosimilars to compete with Amgen. So Amgen is going to make biosimilars to compete with their drugs. It's a war. And if we move along to the next, and I think it may be the final slide, what's up? No, it's the second to the last slide. Oh, it's the last slide. I beg your pardon. So what's up with Amgen? Well, it recently lowered its sales guidance. It is facing competition for Enbrel. It's not as serious as some analysts are saying. It will slow. The sales will slow, but not dramatically, not like a small molecule drug where most analysts have their training. And so I think they jumped the gun a bit when it comes to big traditional biotech companies of large molecules. The company is continuing to innovate. Of course, this is very risky. No one knows what a drug will do, but it is introducing new drugs to shore up its top line. Very difficult to predict how they'll do. It's a very competitive market, but things are moving in the right direction. Yes, earnings are lackluster now, and it's getting punished for that. But that punishment is often a good time to buy a company. I love it, as I said, when bad things happen to good companies. And it seems to be happening to Amgen right now, so that's why I want to add it.
Excellent. Well, thank you very much, Hugh. We appreciate that update. Here's just a quick reminder that we do archive these sessions. If you want to go back and check up on some stuff at YouTube, just search under Manifest Investing and you can find it. If you like what you see there, subscribe and you get a reminder anytime new content is added. So with that, Ken, you can go ahead and conduct a poll. We have quite the split ticket here. I do want to remind the audience that Santa is watching, so he'll know if you're naughty or nice to my company.
And here we go. Just use your mouse, choose one of the companies. If you're on a tablet, I think you can do it with your fingers. I know that folks that are on a phone right now have a little bit of difficult voting, and that's not an issue with us. It's an issue with the platform itself, and we're sorry about that. But we'd love to get about 3/4 or more of you voting. We've already hit 3/4 of you voting, so let's see if we can push that to 85, 90% maybe voting as to what we're going to choose. I'm going to count to 10 and then close down here. We're at 89% voting. There, we just hit 90, and I'm going to close the poll, and I'm going to share the results. And thank you, folks. We're going to put another universal display into the portfolio.
Fantastic.
Okay.
Good stuff. All right. Go ahead, Ken.
Mark, we had a good size audience tonight, and our question box, we had a number of our folks in the back room answering as many questions as they could, but I think we're just at the point where we have too many questions to try to answer very many of them after the session tonight.
Yeah, we ran a little bit long tonight, but I think the content was pretty strong, so hopefully the audience will forgive us for that. Just a quick reminder that we will be looking at summarizing the newsletter on Saturday, December 4th, and the December roundtable is actually just after Christmas, December 28th, and we will look forward to seeing you then after you've all gone out and done your early shopping and enjoyed a fantastic Christmas.
I want to wish our entire audience a Merry Christmas. I want to give special thanks. I did it at Thanksgiving, but I'll say another prayer for of thank you to Cy Lynch and to Kim Butcher and to Hugh McManus, and especially to my buddy Mark Robertson for all the help that you guys give us on this program. It couldn't be done for even a couple of years without you guys. And lo and behold, we're going to move on to our 12th year here coming up pretty soon. So thank you so much for all the help, and a big thank you to you folks that keep on attending. Tonight was one of our best attendance in the last 6 or 7 months, and we appreciate the fact that you seem to enjoy these sessions, because we certainly enjoy bringing them to you. I'm going to wish you all a Merry Christmas, a Happy New Year, and we hope to see you on December 28th for the December Investing Roundtable. Good night, everyone.
All right. Thanks, Ken. Happy holidays, everybody.
Good night and happy birthday, Mark.
Good night, everybody.
Thank you, and happy birthday, Cy. Pre-birthday Eve.
Birthday Eve. There you go. Yep. All right. So long.
Happy
everybody.
birthday to both you guys. Okay. From the other Scorpio in the group. Okay.
I'm going to go get some arthritis medicine, even though I don't have arthritis.
Bye-bye.
Uh-huh.
Well, the other Scorpio girl says happy birthday to everybody too.
Okay.
Thank you.
Here we go.